Well, welcome everybody to our webinar today, which is on captives and alternative risk solutions. And so we know that there's just been a significant amount of interest in this topic over the last really 12 to 24 months. Been a lot of establishment of captives in the region and internationally. Really an amazing period of growth for alternative risk solutions, and so we thought it'd be a real natural time to have a discussion today around what alternative risk solutions are, the applicability of those to certain types of policies and how they work, and the differences, and so I hope you get a lot out of the session today. Today's session will be run by André Kyburz and George Charabaris. André led our alternative risk solutions practice in the Pacific region, and André's previously run the captive practice for a number of major international brokers in the Pacific region. He's had over 30 years experience in alternative risk solutions, and so he's come from Switzerland previously and back in Australia. So we're really fortunate to have André with us today and on our team. And under André's remit is for the Pacific region is protected cell captives, discretionary trusts, parametric insurances, integrated placement solutions, and reinsurance. And so wealth of knowledge. And so we're really lucky to have André today. It's going to be great to hear from him. We've also got George. George is the chair of our risk management practice in the Pacific region and has sat on over 30 captive boards and has a similar amount of experience with André in helping clients on the journey from start to finish, from feasibility, inception, establishment, and guiding clients along that journey. And so really we've got really the best that Marsh can offer in the region, and we're excited to have them here. So we've got the function for you to ask questions throughout. We are going to stop and answer questions throughout the presentation, so feel free to talk and we'll put it through the chat function, and we'll make sure we answer it throughout the presentation, or we'll answer it at the end. And so please use that. And thanks so much for attending with us today, and I'll hand the time over to André. Thanks, André.
Thank you, Zane, and welcome. And yeah, we're very fortunate to have George on the presentation today. He will provide invaluable insights from his many years of advising clients strategically on using alternative risk financing vehicles. Thanks, George, for joining us today. So I think firstly we just run quickly through a few slides, just setting the scene for today's session. And I think the question, why are our clients looking for alternative risk solutions? And I think this slide here will provide some of the answers. It's really a market cycle driven demand for alternatives at the moment, after a very long stance, or I think soft insurance market cycle, probably since shortly after 9/11, when the market went soft and stayed soft for a long time. And what we see here is the premiums and the pricing impacts shown here, over the last maybe 2.5 years, where the market really turned. And as you see here on the slide, this is really the global insurance composite pricing change over that time. And also, of course, the gross written premium globally that has increased dramatically. But I need to say it's not only price driven, of course, the interest in alternatives, it's also very much so capacity driven. We see markets, retracting their capacities, managing their capacities much more carefully than in many of the previous years. And that in itself obviously provides a lot of challenges for our clients. So what we have seen from that emanating, here's one of the results of these hard insurance markets. Captives are formed at a record pace after many years of muted demand. Really, you know, what we've seen in the past year alone is more than 100 formations of captives and cell captives for Marsh clients. And, you know, even in the current year, 2021, we're on track to form another 100 of such vehicles this year, with more than 65 already completed as of today. And, you know, in the early months of this year, mostly captives were formed for property insurance. And I think that's nothing, you know, extraordinary, because obviously property markets have gone up, capacity has retracted, and that's one of the outcomes of it. What we also see, and I think what we're seeing here is really history repeating itself, because we had similar scenarios back in the hard markets, mainly on the casualty and liability side in the 1980s. And both George and I are old enough to remember these. And then also in the early 2000s, after the terrorist attacks in New York, where, you know, markets contracted, pricing went up, and the demand for alternatives shot up. So history repeating itself here. And then also what we're seeing is that cell captive formations are up too, and, you know, experience very rapid growth as a result of the hard market cycle. And a bit different to what we see in the captive space with cells. They're primarily used for D&O, Side B and Side C coverage, and also for cyber, which is, of course, a big challenge at the moment for many of our clients and of course, our colleagues in the broking teams. So these few slides just to set the scene and providing a few reasons why we're actually seeing that increased demand in alternative risk financing structures. So, alternative risk transfer, is it a short-term fix of a problem versus a long-term strategic approach? Well, what is it? Is it a short-term fix, or is it really what we should be thinking about? Is it a long-term strategic approach to tackle certain situations? What we do, where we start conversations with our clients, is really, you know, how they come to us and start, how do we tackle the issue that we have now, you know, increasing insurance premiums, coverage restrictions, and so forth. So we tend to then basically enter into a conversation, a discussion in the first place, where we show and ask certain questions and qualify the reasons and objectives of, you know, the request for looking into an alternative solution. So sometimes clients say, yeah, we're just looking for a silver bullet, you know, fixing a short-term problem. Or, you know, maybe they say, well, maybe it is a longer-term issue that we're going through more of a harder market than having 20 years of soft market. So maybe we should start looking into a long-term strategic option. And, you know, short-term fixes can exist. We see that sometimes when, you know, we have, for example, property placements where one insurer is really just fronting for a bunch of reinsurance markets sitting behind them. And it might be a short-term fix to set up a cell captive, for example, to get access to those reinsurers on a direct basis. But really, this is the sort of conversation we have. Sometimes it's a whiteboarding session, and really to get, I think, the discussion going. Is it short-term an issue, or should we look at long-term? Of course, you see here on the slide as well, there's there's not only alternative risk finance solutions, sometimes it's just a conventional insurance, possibly with greater retentions, or retaining certain layers in programs. Or then it could be parametric insurance solutions that on a standalone basis or maybe combined with traditional coverage are a solution to certain issues and challenges we face at the moment. We're talking a bit more about these various structures and solutions later in the presentation. This is an interesting one, and you could say that this maturity complexity curve almost mimics the markets rising, soft market probably to the left-hand side, and then to a more harder market moving to the right, and I think clients then reacting accordingly. And this is the one where I might throw this one to George to talk a bit more about the complexities and maturity of clients when they talk to us about solutions.
Yeah, thanks, Andre. We quite often use this slide when we're talking to clients in terms of what sort of risk financing strategies do they want? Where do they want to be now, and where do they want to be in the future, and where do they see themselves? The more mature and advanced companies are in the far right, where they're using strategic vehicles, whether they be captives or other solutions, to help shape the program, and using the insurance market as only one strategy, but they have a number of other strategies, including their own risk retention, captives, and also helping drive pricing and capacity through structures that they adopt. And those companies are the more extreme. They're the big mining companies, in some cases some of the banks, using captives they've had for 20 or so years, for example, where they may be participating in the program very strategically. On the far left would be your more transactional buyer, where we're totally relying on the insurance market and not really being able to drive any strategy, effectively just price takers, and the market determines what you get there. And the conversation with the client is, where do you want to be, and what should you aspire to be? And quite often that brings us to the middle of this, where there's obviously a shift away from transactional insurance buying, a bit more of a strategic approach, and starting to form structures or solutions that actually allow them to participate in the risk more. I have a very simple discussion with clients that I say to them, the best way to reduce the cost of insurance is buy less. But how do you need to understand what your risk is, what your volatility is, and how you can manage that risk. And really that's a stepped approach that probably moves you to a risk-led discussion in the middle there as a more immediate step, and then longer term moving to the far right. Okay. Yeah.
Thank you, George. Thanks for those explanations, George. So what do we do? I mean, after that initial discussion where we identify, I think, the challenges and the issues, it's then basically we're going to take the clients or the people or prospects that we're talking to onto a journey to an alternative risk transfer solution. And really the first one that we're talking about is the client's risk-bearing capacity, or also known as risk tolerance. And sometimes we just do a desktop financial analysis of the latest annual reports, where we can see how certain KPIs of the company would be impacted if they took on more risk or retained more risk. And so this is all about talking about risk tolerance and risk appetite. Appetite and tolerance, two different things. Tolerance, usually just the outcomes of that financial analysis, might be really big. And then, of course, the board would say, but we're not willing to risk all that spare retention capacity that we have, and maybe the appetite is then somewhere here. So that's the initial discussion that we have, and then basically from there on, and that's very important, we then move on to really do some of the analytics work, model losses, and that could be based on losses that the organization itself experienced, or if there's a lack of own loss experience, we can supplement our financial or our analytical models with industry data, and then basically look at those loss models and then go through a risk finance optimization process where we look at the pricing structures, the technical pricing of the different layers in a program, and overlay the loss models, and then basically can say, I think from the outset, I mean, George and I had a lot of these discussions with our clients, and what we usually see when we do that phase 2, and the question, should you retain more risk, then we can probably already tell whether it's necessary to go through a proper feasibility study to set up a captive or some other alternative structure, or whether it still doesn't, or whether it won't make sense. I mean, most of the time we can tell from the outcomes or the results from those modeling exercises whether there is an alternative risk transfer vehicle that is viable to pursue.
André, can I just add there that
yeah.
I've also found that the risk modelling becomes very helpful for the clients when they need to engage other stakeholders in the organisation to bring them along. I mean, obviously the feasibility study will incorporate that, but in the early stages of establishing the merits of whether they go forward to a full feasibility and whether a captive strategy or other solution is a right step for them, the modelling work and scenario-based work is incredibly important to bring in terms of showing the value of the suggested outcome.
Mm. Yeah, thank you, George, for those additional explanations. Then, of course, if the modeling and analytics work points towards, yes, a alternative risk finance solution is viable and feasible, then we go through a proper feasibility study, which then obviously provides additional information such as, review of domiciles, review of domiciles, which vehicle, should it be a PCC or a captive or something else. Also, it will match the potential domicile choices to the footprint of the parent company, because it wouldn't make sense to put, a captive somewhere onto a Caribbean island when the company has its main operational units in Europe. Then you would probably look at a European domicile where, a captive could ride direct in some of those European countries. So that would be validated in the feasibility study, and the feasibility study would then also provide those 5-year projections of how a balance sheet, the P&L and the cash flow statement could look like for a captive or a PCC going forward. And then, of course, very important at the end, I think, is the longer term plan, how to retain risk when and where. And that's where we revisit, the strategy every year and probably agree on a midterm plan in the first place, but review the plan every year and adapt the strategy accordingly. Okay, now a short intro to the pros and cons of alternative risk transfer structures. Really short, positives and negatives, and of course, a company or an organization could always decide to just retain more risk on balance sheet. And as George mentioned before, just buy less insurance, increase your deductibles and excesses, and keep them on balance sheet, and apply a pay-as-you-go system. So you pay the claim when it happens. It might even be that you plan to put some, funds aside, create reserves that you're prepared to pay claims when they happen. But in my personal experience over many, many years, these funds, even if they're set aside, they usually get hijacked by some more important issues. And when a CFO sees a few $1 million set aside and they have an expansion program, for example, that those funds might simply disappear and not be there when the claim actually happens. Of course, in Australia, we have a specific solution, but probably more for the affinity type, association type insurance buyers. These are the discretionary trusts. They've been in the Australian market for probably about 30 years, where multiple unrelated entities with similar risk profiles put their buying power together and pool funds to create a retention vehicle in a trust and then buy insurance to wrap around the trust. Then, of course, I think the more popular structures that we see are the protected cell captives and the wholly owned insurance company captives. A lot of Australian corporations have these in place and have had them for many years. Most of them, I would say, are running quite profitably and successful. And of course, they really allow you to use them strategically in your insurance placements, whether that be a captive or a PCC. I think different companies employ different strategies. Some are comfortable with setting up their own subsidiary, captive insurance company. Some others dip their toes in with a PCC and see how the alternative approach works for them before maybe then transforming a PCC into an owned captive. So this is really best for large entities with a strong balance sheet and the aim of really strategically employing such a vehicle.
So André, we've got a question come through about what do you see as the real key differences between a protected cell captive and a wholly owned captive?
Well, of course, the ownership structure is different. That's a key difference. Captive is a wholly owned bona fide insurance company, so a wholly owned 100% subsidiary in an environment that is fully regulated. So it's an insurance company regulated by, the MAS in Singapore or the Bermudan Monetary Authority. Whereas a PCC, of course, is a structure that you don't own. You rent a cell in a captive. So you're not the owner, you're just a participant. And I think one of the main differences in terms of being operational, it is probably much easier to exit the PCC than a captive, because the captive is a regulated insurance company. When you want to exit, you need to put specific arrangements in place to novate liabilities that might still reside, especially if you're writing long tail classes in a captive. That could take a long time to actually exit, to have the license revoked by the regulator, whereas in a PCC, the exit is much easier, much faster and straightforward. You can simply, novate the liabilities if there are any left back to the parent entity.
And therefore, is there any, what are the strategic benefits you see for having a wholly owned captive then over a PCC, André?
PCC, of course, it depends where you go with the PCC which domicile. There's usually is collateral requirements that in some instances, in some domiciles, there's what they call a no gap policy in place. So you can't actually, or any risk that remains in the PCC or that you want to retain, you have to fully collateralize. That can be either by full 100% reinsurance that's acceptable to the PCC owner, or collateral like letter of credit, cash in a trust account, and so forth. Whereas, of course, in an insurance company, which a captive is, you don't have to fully collateralize the risk that you retain. So from a capital and collateral perspective, there might be differences there.
I think, Andre, from experience, a wholly owned captive, a lot of companies have used a wholly owned captive to build funds over time, rather than a protected sell. If you're looking to build funds gradually, the wholly owned captive can be more effective, again, subject to jurisdiction.
Yeah.
Just another question on this slide, Andre, is with balance sheet risk retention, is it possible to retain funds over time where accounting standards require funds or reserves to be released each year unless losses are known or almost certain?
Well, it depends. You can create reserves, and I have to say here, everything we obviously say in this presentation, we're not tax advisors or accounting advisors, so always seek your own tax or accounting advice. But in general, from my experience, when you create reserves on balance sheet, if you're applying actuarial models and actuarial methodologies, or maybe even hire an actuarial firm to come up with those reserves based on your historical losses and maybe combined with industry losses, then that's usually accepted by the auditors to be held on balance sheet as a reserve. The only thing that I have to point out is obviously, and again, seek your own tax advice, but in terms of the taxation impact of claims, you can only claim against tax once you actually have the claim and expense it.
That's on balance.
On balance sheet.
On balance sheet, whereas a captive, you can take a provision.
Yeah.
Thanks, Andre.
Okay. Moving on. Of course, when we talk about alternative risk transfer structures, pros and cons, there's of course parametric insurance that has, I think, been very fashionable over the last few years. When traditional capacity goes out the market, then alternatives come in, and parametric insurance is one of them. And I think you see a lot of, well, probably you see on this slide, you actually don't see any cons. These are really the pros about the parametric insurance. And cons I see when, for example, the trigger of the parametric solution is not properly structured, then that sort of insurance wouldn't pay out if the trigger is not hit or met. And I think that's why it's very important to spend a proper amount of time discussing what the real issues are and what events a client wants to cover, because structuring the trigger that triggers the insurance payout is really important here. And if you miss the trigger, you could have a solution in place, which could be a costly solution that will not pay out because the trigger is set in the wrong way. And sometimes, depending on what you're trying to cover, capacity in the parametric markets might not be sufficient to fully substitute traditional cover that was once available. at a very cheap price because, you know, there is limitations on capacity for certain parametric events in the markets. But generally, if they're properly structured, they're really good standalone products, or as we will see later in the presentation, to substitute or, you know, enhance traditional insurance coverage as well. Do's and don'ts, and I think both George and I have seen quite a few do's and don'ts in our careers. I think it's all about understanding the opportunities, but also the downsides. And, you know, again, I think here, particularly on this slide, there's certain pointers where we have to make that disclaimer again, you know, we're not tax advisors or providing accounting advice. I think if someone is looking to explore whether a captive would add value to the overall group risk management process and the total cost of risk, then there's certain things that need to be looked at in the feasibility study. I think it's all about making informed decisions, and what we said before is very important, is the sound analytics underpinning it. What we see and what I've seen in my past, a long time ago, I had a client, they were hit with large increases from their insurance markets, and they were coming to us and started the discussion about captives and, you know, taking on all these, basically half of their programs. And it was, one of them was a liability program. And when we looked at the losses, you know, we told them, why would you assume a risk or retain a risk that is guaranteeing you a loss in your captive? As long as the market is still able and willing to provide you a solution where, based on the analytics we did, they actually gained money every year because the insurer would pay out more than what they charged in premiums. Why would you want something like that to put into a captive? So no participation when losses are guaranteed. I think that's one of the main things. Also, what we usually say is don't go and dabble in cat risk when you know, the captive is at an early stage or in its formative years. Maybe, you know, at a later stage, if you have a very mature captive with a lot of funds to play with, then you might dabble into high up layers. Also, an important one is beware of the large frequency loss portfolios. And the meaning of that dot point here is really where you have a large frequency of claims. A captive is not equipped like an insurer to handle a lot of claims. So if you have frequency portfolios, and, you know, it could be that there's like a large motor fleet that is running very profitable. Like I've seen some of those for car manufacturers, for example, then you would need to structure participation in that program through a reinsurance arrangement where you have a fronting insurer handling all the claims for you, and then basically ceding part of the portfolio to the captive on a reinsurance basis. So you basically get a monthly bordereau and don't have to handle all the frequency claims yourself.
Or André, in that instance, Marsh has a third party, you know, a TPA for administrating claims on behalf of captives as well. So we can manage the motor claims in that instances. It's so that the client doesn't have to manage them themselves or the captive, and do just like what you're saying the insurer might do. That's another option. Yeah. Yeah,
it is an option, although if we're talking motor specifically, of course, it's a mandatory class, sometimes statutory class. You probably need a front anyway to do it and handle the claims. And, you know, even if you're employing a TPA to handle a bulk a bulk claim portfolio, that just means cost that you're churning. And it can be looked at individually, but it's really important to get the right structure in place. Sometimes it makes more sense to participate on a reinsurance basis, and just, if the portfolio is very profitable, take a share of it through reinsurance. Joint ventures, that's usually an interesting theme that we see. There's, in some domiciles, there's hurdles in that you can't write third-party business. And I've seen personally captives where joint ventures were insured, but only for the share that the parent company of the captive owned. And then the other share of the joint venture was insured separately, or even by another captive, by the other joint venture participant.
That's what a lot of the, Andre, that's what a lot of the big oil companies do around the world for their JV. They put their share into their captive, and the share goes to the market or elsewhere.
Yeah. Then an important point here is understand taxation, accounting, and the regulatory issues. Of course, we had, BEPS, which came in with the OECD recommendations. I think that discussion started in around 2016, 17. And in, Marsh and some of the Marsh advisors in our global captive practice were actually party to some input to the OECD, because captives were named specifically in those recommendations or in those early papers. And then the European Risk Managers Association, FIRMA, actually put papers to the OECD explaining the use and the strategic benefits of captives. And I think in the end, some of those inputs that FIRMA and Marsh, as part of the FIRMA input, put to the OECD were actually taken up in their final recommendations. Of course, we always say tax is obviously a component of the decision making to set up a captive, but it should not be driven by tax. And the commercial, I think the commercial benefit of a captive structure should be much bigger than the tax benefits. And if you're applying arm's length practices, separation of duties, and I think in some instances, in some domiciles, there's now a requirement from the regulators to actually employ employees. So captives actually have employees that do some of the administration and the duties in the underwriting process to be completely, in line with what the OECD recommendations were. So this will be an ongoing process. Our colleagues in the global captive practice, they're obviously aware of all these issues with OECD recommendations, BEPS, and other issues. I mean, IFRS, the International Financial Reporting Standards 17, that will come into force in early 2023. That's another issue that captives will be faced with in the next couple of years. And all our colleagues in those captive domiciles are working with their captive clients to be fully compliant with all these rules and regulations. Some use and application of different structures. Cyber is a good example how captives and PCCs have evolved lately. I think initially, and George, you would agree, initially what we've seen mostly over many, many years is that captives were mainly used for property and casualty programs.
Yeah, very much so.
And of course, that has changed a bit with over the last couple of years, I think, when clients were considering cyber, and again, that's based on market pressures that come along with cyber at the moment. And we see here a number, 127% growth over the last 5 years in the number of captives writing cyber. And it's really across industries that we're seeing that trend. So cyber markets, they're obviously further contracting. There's not only the pressure on the premium increases, but also I think more accentuated is really the lack of available capacity in certain layers. And what we see happening at the moment is that a lot of our clients actually try to employ their captives or PCC structures to fill some of those voids left by underwriters, exiting certain spaces in a program. Because they're mostly layer programs, we see that it's still mostly possible to get a decent primary, maybe a $5 or $10 million primary, but then it gets difficult after that primary. Between the space of maybe 10 to 30 or 50 million, we see a lot of underwriters reluctant to play in that space, and sometimes the captive can be a solution and be able to take out one of those first excess layers to then be able to complete the program further up the tower.
André, there's a question that's come through around, do you see utilizing a captive to provide capacity or fill capacity in the cyberspace a quick fix? Like, can it be utilized quickly as a fix? That's the first question. And given the volatility and what's happening in that market, do you see it as a sustainable option moving forward, not just of doing it now to fill capacity, but what's the positives and negatives perhaps of doing it forward? And you might want to touch on some of the challenges if it's writing the primary policy as well.
Yeah, writing the primary policy, it depends on the program structure, of course. Sometimes writing the primary is difficult because you still want all the services that are included in a cyber policy. Obviously, you could still arrange these, with cyber consultants. Your Big Four audit firms provide some of those services as well. I think it would still be an advantage to have that primary out in the market, and then of course the captive can be filling in above the primary or at certain layer levels where you experience difficulties with traditional markets. Is it a short-term fix? I think a lot of people using it as a short-term fix, but there's decent, of course, there's these covers lower down just after the primary are still carrying a nice price tag. So we would put a decent premium for the risk you retain into the captive. And if you don't have losses over a few years, you're building that buffer that you can then use to maybe play the captive in a strategic role going forward, and maybe it becomes a permanent, it has a permanent place in the cyber program structure going forward. Any ideas from your side, George, on that one, using it strategically?
Well, I think if there's a market solution, it's always more favourable. Generally, it's no different to years ago when we had environmental. Clients looked at retaining that risk or put it in many cases did use a captive to help out. But I think cyber's a bit different because you do have a tower and limits you need to buy. And I certainly agree with what you're saying, André. I'm not so sure it's ideal as a primary unless you actually have no other alternatives. I think it's more advisable to start getting involved in the program somewhere to help complete the placement. That's where I think it would be more effective.
Yeah. Thank you, George.
But in terms of the question, I think also asked whether it's short term. I think the answer is that this can be done quickly once you know where you want to play in the program. And if you can capitalise it quick enough, it's certainly something you can put in place pretty quickly.
Yeah, thank you. So we show you a few ideas, and I think from experience where we saw captives and sales play, and of course here we have a more traditional property program where the strategy is basically to use it down low, with that each and every loss and maybe an aggregate in that first loss space. But what we've recently seen is captives also participating with percentage shares in some of the excess layers, especially where we believe, excess insurers get the pricing wrong, and we can then use the captive strategically to fill in those gaps and basically say the pricing is too expensive. If you want that pricing, then we take it with the captive and move you further up the tower. And I think it's creating two things for you in a program structure. It actually reduces the market volatility in those excess layers, because you might be able to move certain markets to a space in your program, in your tower, where they feel more comfortable participating at a decent price tag. And also, of course, the other strategic benefit here is that you can then generate that competitive tension between the layers by saying, the captive will take that, we move you up, and maybe they rethink and are concerned about their premium pool. So this is one option that we see employed in the current market.
I'd say, Andre, that when we have the underlying modelling, we do that modelling, we can use it to overlay the pricing of the layers and run technical pricing analysis on that, what the insurers are pricing it, so you can see where is the inefficiency in the program, and allow your captive to be strategic around not just retaining risk, like you're saying, through a deductible, but through ventilating that program, taking out the bits and pieces and acting like an insurer would, where you can just pick the parts that that it's got a strong business case for not transferring it at that part.
Yes, that's correct. Thank you, Zane. Here's another structure. I think in many ways it builds upon the structure that we've seen before. It's not dissimilar to the one before, but here, of course, with an added protection for the captive through reinsurance. And maybe I'll throw this one to George to walk you through.
Yeah, thanks, Andre. Yes, again, this illustrates very much what Andre was saying, where you may already have a captive retention, but there's an opportunity to increase that retention, or either if there is an existing retention or if there's not, doesn't matter, but to where the captive is used strategically in the placement, more importantly. And it's illustrating here where it may take a share of a placement. As Andre said previously, it might be 10 or 15% of a particular layer. And that effectively is helping with the program structure with the open market placement, where you might be able to move insurers who want to participate at a higher level for part of the placement. And the captive then is strategically participating in that way. But that then may create volatility for the captive, and that the client is looking to protect through a form of reinsurance. And what this is illustrating is the sort of reinsurance that we could buy to cover second or third event type protection through a sidecar placement. So in this example, the captive piece there in the purple might be 50% of a 50 million layer, so 25 million net retention. And then the captive reinsurance that we would seek to buy may then respond and provide effectively 50% of 50 million per event, that is 25 million of reinsurance protection and 50 million in the aggregate, stretched over 3 years to reduce the cost, and then only respond though after the captive's first 25 million has been exhausted. So that's just an illustration of both how the captive may be used strategically to elevate part of the tower and get some benefit from that, and then how we would protect it through a sidecar protection, second event, third event.
Thank you, George. Another conceptual idea, this is basically the evolution of a captive in a property program over a space of maybe 3 to 5 years. And, you know, this one is where the captive starts off retaining some risk at the bottom end. But we see, for example, that those first 20 million are overpriced and cost a lot of money. And then what we could do is actually slide in between the captive in that light blue bottom line and the dark blue excess placement. We can slide in a multi-year captive reinsurance protection program, which purports to the market that the captive is actually retaining 20 million in that first, second, and third year. But in reality, the captive is actually only retaining those 5 million in the first year, 10 million in the second, and 15 in the third. And what this does, it basically creates an opportunity for the captive to access markets that are willing to play above that 20 million attachment point at maybe a better cost. It reduces the volatility in the annual placement and the premium spend, because that reinsurer that provides the capacity in that yellow bit, he might also play and provide you capacity on the annual placement above. And so you can reduce the volatility in the placement itself, but also on the premium spend. And also what it does, usually such multi-year deals, they come with certain benefits if you don't have claims. So if your claims history over the 3 years or the 5 years is very positive, you might get a part of the reinsurance premium refunded as a no claims or low claims bonus. So, yeah.
Can I just add there also, Andre, that another benefit of this structure is as you're building up your captive retention over the 3 years, and as we said earlier on in the presentation, it's desirable to do that, to have a step retention and build up over time. But what this allows you to do whilst you're doing that is effectively borrow the reinsurer's balance sheet if you have an event or a loss above your retention earlier in the structure, before you've actually built up the funds that you would otherwise have had in the third year. You're effectively making use of the reinsurer's balance sheet.
Yes, and I have to say this is not just conceptual. We have actually used a few of these in the past, and as far as I know, the ones that I was involved in, they worked really well for our clients. Here's another one where I think this is probably an example of a very sophisticated approach, where the captive retains multiple risks in the parent entity's programs and then protect its balance sheet, and hence, because it's a wholly owned subsidiary of the parent entity, it also protects the balance sheet of its parent entity with a multi-year cross-class reinsurance deal to limit the overall exposure. And in this example, the limit to the overall exposure is to 50 million in each year, and then 100 million over a 3-year period. So the captive here participates in property liability, cyber and professional indemnity programs, and then basically buys a portfolio reinsurance to limit its annual exposure and its multi-year exposure over the 3 years. What we can say is these deals are really difficult to establish. They take time. They can be done, and we have done them. But a normal timeline to establish such a concept is 6 to 12 months, probably rather towards the 12 months. And one of the downsides is if the cross-class aggregate reinsurance deal is breached, then of course the excess towers do actually not traditionally drop down. So you might still be exposed to a gap if you have multiple losses or an aggregate loss that's in excess of that cross-class reinsurance deal. But this is very sophisticated, can be done, takes time, and has its downsides as well. I think what we're seeing lately is a blend of traditional and parametric insurance solutions to fill gaps or even get additional coverage. And this is just an example where I think through contraction of cat limits in a traditional property program, we can substitute the loss of that capacity or fill in the gaps with a parametric policy. And I think we're seeing a lot of clients that are actually looking into that at the moment. Could also be used to just not on a portfolio basis. So if you have a portfolio of assets, not all of them would be necessarily cat exposed. So you might have some individual exposed locations that you would then include in a parametric solution. We're running out of time, so I'm just going quickly over this. This is another concept that I developed many years ago. It's sort of like a financial market option where you go to a reinsurer and say, can I pay you an option premium to secure committed capital? Like if I'm having losses in a captive during the year, and then if I come up close to the financial year end, can I secure additional capacity just if I have a second or third loss that reaches my financial thresholds? And you might then be able to just invoke the option and buy it and pay a pre-agreed premium, or you can let it lapse if you don't require it, but you would have to prepay an option premium at the start of the year. Then finally, the commodity price swing retention. I think this one I'll throw to George again.
Yes, thanks, André. I'll be brief on this. Effectively, what this is where a client through their earnings or expenses, where those items are highly correlated to a commodity index, such as in mining, gold or copper, or clients may be highly correlated to the oil or gas price. We can look at working up a structure where, in the event of those commodity prices falling sharply and coinciding with a loss event, where the client's retention can be brought down at that time, and the insurer would step in. So you would use this where you're looking to lift your retention to a higher level, but you are concerned that perhaps at a future point in time, the company's ability and risk appetite to respond to a large loss may be impaired if the effective commodity price that they're correlated to has fallen. So we would then go to a reinsurer to see if we could sort of bring in something that would flex from a retention point of view to protect him in that event.
Thank you, George.
Thanks, George. Thanks, Andre, and thanks so much for everyone that attended today. And it's been a great session. We've had a final question come through, Andre. I think it should be a fairly quick one, but it's with a captive. As it's a regulated company, what sort of statutory reporting is required?
Statutory reporting, of course, that depends on the regulations in the domicile. Like in Australia, we used to have a quarterly reporting to APRA. In other domiciles, it's half yearly or yearly. It really depends on the domicile. And then, of course, there's usually management reporting that is in line with the requirements of the parent entity as well. Yeah. It could be monthly, quarterly, half yearly.
Yeah. What would you say in Singapore? Is that, we know a lot of Australian captives are based in Singapore.
Yeah, Singapore is twice annually.
Yep. Twice annually. Okay, great. Well, we know our time is spent, and so we just wanted to thank everyone for attending. We will be sending out the recording of this presentation, so you've got time to reflect on it. Hopefully we'll be able to join you in a conversation in the future if you've got questions, further questions or ideas, and just want to have a discussion around alternative risk solutions. There's quite a number of us that would welcome that opportunity, and so feel free to reach out to your contact at Marsh or your client executive, and would welcome that opportunity. And so thanks again. Thanks to Andre and George. You've been it's been a great presentation, and we hope you all have a great rest of the day.
Thank you.